Hi, and welcome. We are Probita Training. I'll be your host. My name is Tristan White. Welcome to our session today. And so the point of today is to just focus on some of the amendments that have taken place in terms of the guideline that was issued in April of 2022 with respect to property practitioners and the audit, accounting, and trust accounts. And so our focus today is just to help you sort of move from the old guideline, so the first issue, to the finalized version. And so I'm going to walk you through that today. Our agenda looks as follows. We're going to do a bit of an introduction just to sort of set the scene, bigger picture, and then we're going to move into just an overview of the changes that have taken place from the draft guidelines to the finalized guidelines. And so the draft guidelines came out in April, and the finalized guidelines came out a month later, the end of May 2022. Thereafter, we'll move into the details, and so just highlight what has changed specifically. So to set the scene in terms of the overall picture, in terms of our profession, being property practitioners, we had seen a shift in terms of legislation. So the old legislation being the EAAA, the Estate Agency Affairs Act, and everything that flowed from that. That was what we had as our former legislation. That has been replaced from the beginning of this year, so February 2022, with the new PPA, the Property Practitioners Act, and then the regulations. And then there was an additional publication in the form of guidelines. And that's what's going to be our focus for today. So initially, the Act and the regulations came out on the 1st of Feb or became effective on the 1st of Feb 2022. That was then supplemented with the draft guidelines. And so the guidelines were to help flesh out some of the details, some of the gray area in the Act and the regulations, specifically focusing on the accounting requirements, the accounting rules in the Act and regulations, the audit side of things, and then also trust accounts. And so the initial guideline was published 1 April 2022. We're given about 2 weeks or so to give commentary to the PPRA, the Property Practitioners Regulatory Authority. And then they took all of our commentary, etc., into consideration and published the finalized version towards the end of May. So when we had initially done our first training session on the guidelines, the draft guidelines, that would have been during May. So that was based on the draft guidelines, not the finalized guidelines. And so this is just a follow-up of that session that we did in May this year. And so the final guidelines are now effective. They became effective from the end of May 2022. So how are these guidelines set out? They are, I would say, 12, let's say, sets of paragraphs, and then we have some annexes. And so that we'll still see. So from the old guidelines, the draft guidelines, to the now finalized version of the guidelines, we see a similar play. So we've got 12, let's say, groupings of paragraphs dealing with various subject matter, and then we have annexes 11 in total. So that stays the same. So in terms of the number of paragraphs, in a sense, we're still seeing the same sort of breakdown from the past to the new one. Where are we going to see changes? Yes, so we'll see. So we'll see some changes within all of those little paragraphs. But from the annexes perspective, what has changed? So in terms of the draft annexes, or let's say the annexes that came with the draft guidelines, we had 11 annexes. So we'll still see 11 annexes, but some of the former annexes have been deleted. So if you try and follow the color coding, you'll see we've got green, meaning the affidavit. That one is still continuing in the finalized version of the guidelines and the final annexes. And then from 2 to 4 of the old annexes or of the old guidelines, these 3 in red have been deleted. So we had a template letter that would need to be issued by the bank to the property practitioner whenever they wanted to open up a trust account. So that document has been deleted. Number 3, whenever you decide to close your trust account, so in other words, you need to liaise with the bank. The bank will give you a bank closure letter or trust bank account closure letter. That has also been deleted. So it isn't in the final version of the guidelines. And then the third thing that was deleted from the old guidelines to the new guidelines is the annexure to do with the naming convention of the trust accounts. So effectively, whenever a trust account is opened as a property practitioner, or otherwise the trust savings account, it has to be named in a certain fashion. In other words, there has to be a reference made to the section from which it comes. In other words, section 54. So there was a template in terms of giving us what the naming convention was that the bank has to use when they are sort of giving a name or description to the bank account that a property practitioner will open up. That naming convention has, or that template, shall I say, has been deleted. Okay, so from 2 to 4, those are deleted. Now, what's happened in terms of the final annexes, all these here in orange, these have just shifted one down, shifted. So in other words, we go from 1, 2 is deleted, 3 is deleted, 4 is deleted, and then we move to number 5. So you'll see now number 5 in terms of the final guidelines becomes number 2. Number 6 becomes number 3. So they all just shift up by 3 numbers. So in other words, it goes from 5 to 2, from 6 to 3, from 7 to 4, etc. So all of these in orange are basically what is repeated, what is going to continue in the finalized guidelines. So we still have a trust audit report template. It's now number 2. So just take 5 minus 3 because we delete the first 3, and that becomes number 2. Summary of the audit requirements is number 3. Number 7, requirements for exemption from a trust account becomes number 4, and so on and so forth. So all of these in orange are continuing in the finalized guidelines. And now you'll notice that they are these 3 in a different shade of green. So these over here set out what the new letters are. So there are some new templates that were not seen in the first version of the guidelines. These are brand new. So we'll start out with number 8. Number 8 is the Trust Environment Audit Report. That is a new template letter, and I'll explain this to you in the context when we get to the trust account audit discussion of it later. Number 9, list of mandating property practitioners of a property practitioner's agent. Or sorry, a payment processing agent. So this is also a new letter. It's a letter that a payment processing agent has to hand to the PPRA, and it lists all of their clients. So if you think about PayProp might have a whole host of property practitioners that they open up trust accounts for. This number 9 template here sets out all of those clients. Then we have number 10. Number 10 is the trust account exemption letter. So number 10 is also new. It's a letter that the Property Practitioners Regulatory Authority is going to give to a property practitioner when they apply to have their trust accounts be closed. So it's almost an authorization letter from the regulatory authority saying, yes, we acknowledge that your trust account is closed. And so this is a brand new template or a brand new document. And then we have number 11, which is the FAQs. And so the FAQs continue from the past to now. So this is just a look at the annexures that have changed. So from number 2 to 4, they've been deleted. All of the others in orange, they continue in the new guidelines. And then we have these 3 additional ones in green. So we'll explain these annexures in context. So that's just the changes that have happened in the annexures. Now, for the actual paragraphs that have been changed. And so we're going to go through each of these in detail. And so basically our conversation starts from guideline number 6. So if you had to open up the guidelines, you'll see that there are a bunch of paragraphs from 1 through 5, but they don't contain very important information. It just gives, for example, some definitions, some abbreviations, who this set of guidelines applies to. So there's not much there that's changed and that's important for us. Our conversation starts from number 6. So from number 6, or let's say section number 6 of these guidelines, that's where we start to see some changes. Okay, so part number 6 of the draft guidelines, or of the guidelines, sorry, deal with the annual financial statements requirements. And so it's listed from paragraph 6.1 to 6.5. What has changed in terms of the final guidelines? So we've got draft references here, and we've got final guideline references here. And so once again, we see 6.1 to 6.5. What has changed specifically? Paragraph 6.4. And so there's a specific reference that has changed, and I'll explain all of these in context to you. So just take note, specifically paragraph 64, there was a change. Then in terms of number 7, or guideline number 7, dealing with the trust accounts, it goes from paragraph 7.1 to 7.35. In terms of the finalized guidelines, there are a few more paragraphs. It goes from 7.1 to 7.38. And so what was amended within this? Several paragraphs. So what was amended? What was the nature of the amendments? There were some additional paragraphs brought in, and there were some of the old paragraphs that were changed or edited. And so here are all the paragraph references that were changed as part of guideline 7. Okay, and we'll go through each of these as we run along. Then we have part 8 or guideline 8. It deals with other legislation that could impact on a property practitioner. So compliance with FIC, the Financial Intelligence Center Act. We have paragraphs 8.1 through 8.9. What was specifically changed? Paragraph 8.9. And so we'll take a look at that in context. Guideline number 7 deals with the Debt Collectors Act, which has an impact on certain property practitioners. There was an amendment to paragraph 9.5. Guideline number 10 deals with the Auditing Profession Act, and there was a slight change to paragraph 10.3 in the final guideline. And then in terms of guideline 11, which deals with the need for a property practitioner to think about tax-related legislation, so VAT and Income Tax Act, etc., there were no amendments from the former guidelines to the final guidelines. Then in terms of our transitional provisions, which was dealt with in guideline 12, there were some small amendments, being paragraph 12.2 and 12.3. And so I'll explain each of these amendments as we run along. The last one to bring to your attention is in terms of the annexures. Okay, we have taken a look at which ones deleted, which ones were continued, and which ones were brand new in the final version of the guidelines. just to take note that we have a particular guideline from the old guidelines being, a particular annexure being Annexure 6, which is entitled Summarized Audit Requirements that Apply to Business Property Practitioners. This was, of course, renumbered to number 3. However, there was a particular change or clarification in this annexure. So not only has the number reference changed, but also there was a correction in this annexure, which I'll explain to you when we get there. All right, so let's go through each of the changes in detail. That was just an overview of where to look in terms of what has changed. Let's quickly look at it in detail. So starting out with guideline number 6, which deals with the financial statements, what has changed? Guideline 6.4 has changed. So if you want to know what the references are, just go back to the overview so you can see me go through each of those. Now we're actually going to go into each of those in detail. So guideline 6.4, this was changed how? It was changed by bringing in some extra words, the extra words being a reference to company and CC. So essentially, guideline 6.4 says that even though the Property Practitioners Act and regulations might lead you to an independent review of the business financial statements, the Companies Act might override that requirement. So in other words, the Property Practitioners Act and regulation says do an independent review of the business records. But the Companies Act might come alongside and override that and say, ignore that, you actually have to do an audit because the Companies Act requires an audit. And so the clarification that was brought in was the reference to a company and a CC property practitioner. In other words, if you think about a property practitioner, we could have several types. We could have a sole trader, we could have a partnership, all of those legal forms trading as a property practitioner. And so this implication whereby the Companies Act can override the Property Practitioners Act only applies to company and CC property practitioners. And so the sentence or this wording was brought in to make reference to it only applying to a company and a CC. And that was the only change. Now for guideline number 7, which deals with trust accounts. And so how this slide and the next few slides are going to be set out, you'll see wherever there's a reference in red, that is the additional wording, or that is what was changed in this particular paragraph or in this particular guideline. And then in the block at the bottom, we'll basically just try and explain it in a bit more detail. So guideline 7.3 had to do with the opening of a trust account. So whenever a property practitioner opens up a trust account, then they need to look at guideline 7.3. It gives some guidance. And so it basically said that whenever a trust account is opened up, there has to be a reference to the act in terms of that trust account. So in other words, the bank has to say this is a section 54.1 trust account or a section 54.2 trust savings account. And so in the old version of these guidelines, it made reference to Annexure 4. Annexure 4 had the naming convention for those references to the act for every trust account that's opened. Now what's happened is that the Property Practitioners Regulatory Authority have said, you don't need to follow the naming conventions. We ourselves, as the regulatory authority, will speak to all of the banks and we will decide what the naming convention is behind the scenes. Okay, so that's the change. Formerly it said the naming convention has to be in line with Annexure 4. That's been deleted. Annexure 4 does not exist. The naming convention is going to be agreed between banks and the regulatory authority. So this doesn't actually affect you, for example, if you're an auditor or property practitioner, but it's just something to be aware of in terms of what has changed. The next guideline that was changed is 7.4, still dealing with the opening up of a trust account. And so what needed to happen was, as soon as you open up a trust account, the bank has to issue you as a property practitioner with a letter. And so that letter used to be in the form of Annexure 2 in the old guidelines. Annexure 2 has been deleted. It was entitled the opening up or open trust account letter. That the format of that letter is now going to be decided between the bank and the regulatory authority. So that was what was changed in 7.4. 7.6 brings something that's a little bit interesting. So guideline 7.6 deals with trust accounts, specifically the need to keep trust accounting records. So if you are not exempt from running a trust account, in other words, you have a trust account and you're running it, you have to then keep trust accounting records. And so what has changed in terms of guideline 7.6 is that not only are you supposed to keep trust accounting records, but you're supposed to keep trust accounting records using the cash basis of accounting. So this reference to cash basis of accounting is brand new in 7.6. So it's one thing to keep records, but you need to keep records in terms of the cash basis of accounting. So whenever there's a flow of cash, you need to go and capture that transaction. Remember, trust accounting doesn't follow IFRS. Trust accounting will follow cash basis accounting. So I don't have recognition rules like you'd see in IFRS. I go and capture something whenever there's a flow in of cash because it's physically a trust account. It's a bank account. Now for guidelines 7.10 through 11. And so these sets of guidelines deal with the audit requirement that's placed upon a trust account. And so what has changed was, as part of your responsibilities as auditor, that's identified in Guideline 7.10 through 7.11, what you'll have to do is, as part of your audit engagement, not only will you have to be registered on the PPRA's website, you'll have to report on the trust account that you've undertaken the audit for, and then you have to go and make sure that the report that you submit is in the form of a particular annexure. And so in the old guidelines, the annexure reference was annexure 5. It is now annexure 2. So all that's happened is there was a change in annexure reference. So in other words, when you carry out your audit, what do you have to submit as part of the audit? Your trust audit report. How do you do that? It's going to be based on the example in annexure 2. It used to be the example in annexure 5, but that was the old guideline. It's been renumbered to annexure 2. So here's how annexure 2 looks. Okay, isn't much difference between the old guidelines and the final guidelines. It's just a change in the number of the annexure. Next set of guidelines that had been updated or amended, specifically guideline 7.12, still dealing with audit. And so there was just some clarification brought in here. So if the trust audit report is submitted late, so we know that we have either a 4 or a 6 month deadline based on the circumstances. If the trust audit report is submitted late on the portal, then there is going to be a penalty that applies. And so the clarification that was brought in is to say that this penalty is not payable by the auditor, but is instead payable by the business property practitioner. Okay, so for late submission of the trust audit report, it is payable, that penalty, by the business property practitioner, not by yourself as an auditor. Another thing that has changed is the reference to the maximum fines. So in other words, if you wanted a breakdown of the fines that could apply to a property practitioner based on how they have contravened, the old reference was to annexure 8. It is now annexure 5 in the finalized version of the guidelines. What else has been amended? So we need to turn to guideline 7.17, and this deals with unidentified receipts or unclaimed amounts. So in other words, you have a trust account, there is a deposit into the trust account, and you cannot make out to whom this money belongs. What you'll essentially have to do with this is, after 3 years, if no one comes forward to claim that money, you'll have to pay it over to the property practitioner's fidelity fund. Now, the process or the timing of that payover of those unidentified amounts is based on guideline 7.17. And so all that we're seeing that was amended was, we were just given a specific reference to timing. So in other words, when you submit your trust audit reports, in that trust audit report, you have to go and disclose how much of the amounts, or what are the amounts of unclaimed, how much was unclaimed, in other words, that's sitting in the trust account. And whatever the amount is that then becomes due to the fidelity fund in that year, you have to go and identify or specify or document in your trust audit report in part C. And so what's going to happen is that the fidelity fund is going to receive the trust audit report. They're going to look at that part of the trust audit report where you've disclosed how much is unclaimed and has to be paid over to them. They're going to look at that. They're going to send an invoice then to the property practitioner, and that invoice is going to come 30 days after the trust audit report was received by the fidelity fund. Once you receive the invoice, you're going to have 30 days to settle that invoice. And so the change that has happened is, it specifically says 30 days from the date of the invoice. So that's the deadline for the property practitioner to settle or to pay over those unclaimed amounts that then become due to the fidelity fund because they've been sitting there for 3 years or longer. Now for guideline 7.18 through 19, there's been a slight change. And so what this change has to do with is that the bank has to send a certificate. So basically almost like an IT3B to the property practitioner's regulatory authority, which will set out what the interest was that accrued on the trust accounts that were open. So the 54.1 or the 54.2 savings account. Now, when it comes to that document or that certificate that's to be submitted by the bank to the regulatory authority, there is a deadline. So this is not really going to apply to you sitting in this training, but it is applicable to the banks. They have to send almost like an IT3B or a document that's in this form here, in the screenshots. They have to send this to the regulatory authority. And so what the amendment is the time deadline by which it needs to be sent. So under the old guidelines, the draft guidelines, the requirement is that this document had to have been sent by the 1st of June from the year 2023 going forward. But in the current year being 2022, it would have been 31 July. That has been amended to say that for the current year 2022, it needs to be submitted by the 31st of August, but going forward, it needs to be sent on the 31st of May every year. Okay, so just a date difference from the old guidelines to the new ones. Now for interest. And so trust account, what happens is that trust account is going to accumulate interest or accrue interest. And between the trust creditor and the property practitioner, they have to decide to whom the interest belongs. If they don't decide, then it goes to the regulatory authority or it goes to the fidelity fund in full. And so guidelines 7.20 through 7.24 deal with interest that is generated on the trust accounts. Now, the changes that we are going to see are twofold. The first change is to do with the reference to the trust report. So when it comes to the interest that is accruing on a trust account or on the trust accounts, it has to be disclosed by the auditor in the trust audit report in Part C. So the change in terms of the old guidelines and the new guideline is just that the reference to the trust report has changed. It used to be Annexure 5, but it is now Annexure 2 under the finalized guidelines. So just that reference change. Aside from that, when it comes to the interest, there's also a deadline for payover of the interest that accrues in the trust account. So all the interest that then belongs to the fidelity fund has to be paid over by a particular date. And so what's going to happen is that the fidelity fund are going to wait on the auditor to submit the trust audit report on the portal. They're going to look at that report and they're going to look at Part C and they're going to look at how much interest then belongs to them. What they're going to do is they're going to then make out an invoice that they're going to send to the property practitioner. And that invoice that's sent to the property practitioner is going to have to be settled. And so the settlement date, in other words, you have to pay over the interest that's going to be invoiced that is actually due to the fidelity fund. That is going to have to be paid by 30 days or within 30 days of the invoice date. So the only change here was that there was the introduction of some additional wording. In other words, 30 days in relation to what? And so it's just some clarification that states you have to settle as a property practitioner the interest amount that's due to the fidelity fund within 30 days of receiving that, or within 30 days of the invoice date that you receive from the property practitioner's fidelity fund. Now for the next set of adjustments or amendments, what's important to keep in mind here with the next set of amendments is that we first have to understand some stuff before we go in. So on this particular slide, we're not going to address any specific amendment, but we just need to have some context before we move into the next set of amendments. So what we're seeing on this slide is that there are 5 situations whereby a property practitioner will be exempt from running or operating a trust account. If I don't need to run a trust account, it means I don't need to have a trust account audit. It also means I don't need to keep trust accounting records. So here we have the 5 scenarios that lead to you being exempt from needing to operate a trust account, which will mean you don't need to have it then be audited. So we're going to focus on some of these because there were some amendments to some of these. So let's take a look. So we're going to start out with number 2. So if we were to quickly go back to the previous slide, just for context sake, we have 5 such situations. We're not going to go through all, only some of these were affected by the amendments. So specifically exemption 2, this is a situation where a property practitioner has decided that they are no longer going to receive money into trust. And they've then made the decision to close down their trust account. So they're not going to receive any money at all. They're not going to use a payment processing agent. They're just going to close their trust account and no longer receive money in trust. That's the second scenario that leads to an exemption. And so what has changed is just the reference to the letter. So there are a couple of things that need to be done by the property practitioner to qualify for this exemption. So they can't just decide to phone the bank and close the trust account. There's some other things that they have to do. There are letters they need to submit, et cetera, et cetera. So the one letter reference that has changed was the need for them to submit to the regulatory authority a bank closure letter. So in the old guidelines, we had Annexure 3, which was where we found the trust bank closure letter. This letter has been deleted or reference to that letter. In other words, the bank and the regulatory authority will decide what the template is for that letter. And the bank is going to give it to you when you decide to close your trust account. You as a property practitioner need to hand it to the regulatory authority. And this will all be done usually through the portal. The next exemption that has some amendments to it is exemption 3. Exemption 3 deals with a situation where a property practitioner is closing their own trust account and they are opening one through a payment processing agent. So like a PayProp. Now, to qualify for that exemption, there are several steps that have to be followed. So actions and letters that need to be submitted. And so specifically, what has changed in terms of the final guideline is just references to the letters or references to the annexures. So in other words, once you decide to close your trust account, because you're going to open one with, for example, PayProp, you have to get a bank closure letter from the bank. But the template for that letter is no longer going to be based on Annexure 3, that was deleted from the final guidelines. The bank and the regulatory authority decide on that template. They'll give it, the bank will give it to you. The other reference, the other thing that has changed is that you need to submit to the regulatory authority another letter. And so this letter that is referenced is the letter that has a reference. It used to have a reference to Annexure 9. It's now merely a reference to Annexure 6. So in the final guidelines, there's just a change in numbering. So there's that letter that needs to be received from the payment processing agent. And effectively what that letter sets out is the payment processing agent is going to confirm that all the money that you had in your trust account before you close it has been paid to the payment processing agent. So it's just a letter confirming that they have received that money and that you've closed your trust account. Okay, so all that's changed is the reference to Annexure 9 is now no longer that, it's now Annexure 6. You still need to get that same letter from the payment processing agent. So here's how that letter looks. It's just a letter to say that we confirm that we've received or transferred all of the money out of the closed trust account into the payment processing agent's trust account that was opened up on behalf of that payment processing agent. Exemption 5, this is the final type of exemption. This is the situation where you're a managing agent of a body corporate. And so as a managing agent of a body corporate, you would have had to open up a trust account on behalf of that body corporate. And so this 5th exemption is a scenario where you can apply to close that trust account. And the reason for that is because the body corporate has to open up a trust account based on their own legislation, sectional title schemes, management legislation. And so the only changes that we'll see here would be changes to, first of all, the bank closure letter. So effectively, the managing agent is going to close their trust account, meaning they need to get a letter confirming the closure. It used to be based on Annexure 3, that's been deleted. The bank will still give you a letter. It's going to be based on a template that's decided between the bank and the regulatory authority. The other change that has taken place is the need for the property practitioner, for the managing agent to obtain a letter from all of their body corporates. So all of the body corporates that they are a managing agent over, they basically need to get a letter from each of those body corporates saying that they have received permission to close those trust accounts that the managing agent has opened up. And so the only change we're seeing in terms of that, so that letter still remains the same from the previous guidelines. However, there's just a reference change. So it used to be Annexure 10. Ooh. Sorry, let me just reset, press something. So it used to be Annexure 10. It is now Annexure 7. Okay, so the need for the managing agent to obtain letters from each of their body corporate clients before they close a trust account, confirming that the money has been transferred out of the trust account and into the body corporate's own accounts. That's the letter that the managing agent has to obtain, just a reference change from Annexure 10 to now Annexure 7. And here's how that letter looks. Okay, so it's from the body corporate's perspective. Now, what is brand new? A brand new paragraph is paragraph 7.30 or guideline 7.30. And so what this sets out is that once you have applied for exemption, so whatever the scenario is of those 5, once you've applied for one of those exemptions, you need to send all of the documentation, you need to take the respective actions, in other words, close the accounts, have a trust audit on the closed account, etc. Once you've taken the actions and submitted all the letters, the PPRA will then respond to you. So the regulatory authority will come back and say, yes, we've received the documents, we acknowledge the closure, we acknowledge that you've qualified for this exemption, and what they're going to send in return is Annexure 10. So Annexure 10 is the document from the regulatory authority saying that we confirm the closure of your trust account. Then that will mean that you don't need a trust account going forward. You don't need to have it audited. You don't need to keep trust accounting records. So this requirement for this paragraph 7.30 is brand new. Okay, it's just saying that you're going to get a letter. But there's certain things that you need to make sure you've done. You've submitted documents, you've taken actions, and they will then give you a letter confirming. So that letter is going to confirm that the exemption has been accepted, but it's also going to confirm the date that the exemption becomes effective. Here is that Annexure 10, trust account exemption letter. This is how it looks. So this is a letter essentially that's going to be from the regulatory authority to the property practitioner. Now for the next set of amendments, we're specifically going to hone in on payment processing agents. Now, what is a payment processing agent? A payment processing agent is the situation where you have a client who is a property practitioner and they decide to use a third party to run a trust account on their behalf. So for example, a pay prop or something like that. Now, when that is the scenario, then there are some extra requirements that apply. And so in terms of the exemptions, that is one of the grounds for exemption. So in other words, the property practitioner can decide to close their own trust account and instead open up one with a pay prop, for example. but they need to go through all of the steps to qualify for that exemption. That's exemption number 3. Now, if we're dealing with that case or that scenario, then there are some additional requirements. And so we're going to go into the amendments that deal with those requirements that flow from that type of exemption. So in other words, that apply to payment processing agents. So the paragraph that has changed is Guideline 7.32. And so this is a situation where we have a payment processing agent, so for example, a payprop, before they can accept the request to open up a trust account on behalf of a property practitioner, there's some things that they have to do first. And so what they need to do is they themselves need to be registered as a property practitioner. Aside from that, they have to be in possession of their own Fidelity Fund certificates. And what's changed is that they have to make that Fidelity Fund certificate available to the property practitioner that's approached them to ask to have a trust account opened on their behalf. Aside from that, the payment processing agent has to be registered with the Payments Association of South Africa. So this is also a brand new requirement. But then again, this applies to payprop, not necessarily to your client, for example, who's a property practitioner. Next set of amendments, specifically set out in Guideline 7.34 to 7.35. The changes that we'll see have to do with references to annexures. Also, some extra audit responsibility. So what are we dealing with here? We're dealing with a payment processing agent, a payprop, and whoever their auditor is. So usually this is a PwC or someone like that. So these requirements or these amendments are not necessarily going to affect the people in this training session, but it's important to just bear in mind. Okay, so the auditor of a payprop or the auditor of a payment processing agent, they have some responsibilities. And so what are those responsibilities? They first of all have to audit the trust account environment. So not just the trust accounts or the transactions, but the trust account environment so that they can complete a particular annexure that's brand new. Annexure 8 is a brand new annexure. It's called the Trust Environment Audit Report. Okay, so please note there are 2 audit reports, the Trust Environment Audit Report and then the normal Trust Audit Report. Now, the Trust Environment Audit Report is only going to apply to when we have a payment processing agent, so like a payprop. This document doesn't apply to a normal property practitioner client of yours unless they're a payment processing agent. Okay, so audit the trust account environment so that you can complete the Trust Environment Audit Report, which is in Annexure 8, brand new annexure. And then there's some additional audit responsibilities. Not only do you have to audit the environment, but you also have to audit the trust accounts and the individual transactions of all of the payment processing agent's own clients. So in other words, a property practitioner approaches a payprop then opens up a trust account for each of their clients. And so as part of the audit of payprop, you're going to have to trust accounts of all of those clients and the transactions. And so you'll do it in a reasonable way. So once that has been completed, then you can submit as auditor of the payment processing agent, the Annexure 2. So the change here was just a reference from Annexure 5 to Annexure 2, which is the Trust Audit Report. So just a change in numbering. So here's that Annexure 8, the Trust Environment Audit Report template. Okay, brand new one, only applies to the auditor of a payprop or an auditor of a payment processing agent. This is not a normal document that you complete under normal circumstances. What else has changed? Guideline 7.37. So there was just some clarification brought in here, and then there were some new documents that were mentioned. So the first clarification that was brought in is that if you happen to be an auditor of a payprop or an auditor of a payment processing agent, what do you have to submit on the online portal? You have to submit a single report. In other words, if we think about it like this, we have a property practitioner. They decide to close their own trust account. They decide to approach a payprop. So a payprop is our payment processing agent. The payment processing agent opens up one trust account for your client. Then someone else approaches them, let's say property practitioner number 2, and now they go and open up a second trust account, and a property practitioner number 3, and they open up a third trust account. So this payment processing agent now has 3 trust accounts for its respective clients. Now, if you're the auditor of that payment processing agent, then you're going to have to audit each of those trust accounts and the transactions that flow in and out of those accounts. But by the end of your engagement, you don't have to send a separate report for each of those respective clients. You will just send a single audit report from all of the work you've done. And that's what the clarification was that was brought in. Another change that was brought in was just a reference from Annexure 5 to Annexure 2, which was the change in the reference for the trust audit report. So you send your single trust audit report as an auditor of a payment processing agent. And then what's new is that if this is the case where you are the auditor of a payment processing agent, then the regulatory authority are going to send you something in return. They're going to send you a proof document, a proof of submission. In other words, they're going to acknowledge that you've submitted your trust audit report on behalf of the payment processing agent. So there's going to be a specific response. And now this is important for you, even if you're not an auditor of a payment processing agent, because there is some other references to this later on the slides to come. What else has been amended? So on the online portal, if you're the auditor of a PayProp, not only do you submit your trust audit report, a single one, and then in return receive a proof of submission from the regulatory authority, you also need to go and submit a list. Now, what is this list? This is the list of all of the payment processing agents' clients. So the 1, the 2, and the 3, or the PP1, PP2, and PP3. So that is also going to have to be submitted. Okay, a list of all the mandating business property practitioners. What else do you need to submit in that case? Annexure 8, which is the trust environment audit report. So these are the little amendments that have happened. Here's Annexure 9. It's also a brand new annexure. Okay, it's a list of the mandating clients. In other words, we list all of our clients as the payment processing agent. So property practitioner 1, 2, and 3 would be on this list. That has to be submitted every year as part of your submissions if you're the auditor of a PayProp, for example. Now, it was important to speak about that, even though you might have felt that that's irrelevant for you, because it is going to impact on you potentially. And so I'm going to show you how that is going to be the case. So let's look at Guideline 7.38. So Guideline 7.38 is also a new set of paragraphs. So in other words, what the payment processing agents, remember PayProp, what they have to submit to each of their clients. Now let's try and paint a picture. Here's the property practitioner. Here are you as the auditor of the property practitioner. Your property practitioner clients has closed their own trust account and they've opened up a trust account with the payment processing agent. So their trust account is being run by the payment processing agent. What does that mean for you as the auditor of the property practitioner? That means that you are not going to audit the trust account of the property practitioner because they've closed theirs. Now, the one that was opened with the payment processing agent, that is going to be audited by the auditor of the payment processing agent. So for example, a PwC. So you are not going to get involved in the trust account audit, but you might get involved in the business records audit. So the business financial statements audit, or otherwise, if you qualify, the independent review. That's where you might get involved. You're no longer going to be involved in the trust audit. However, there are some things about the trust account engagement that you need to be aware of or need to have access to. And so Guideline 7.38 goes and sets that out. So here we have the payment processing agent. What do they need to give to your client, who is the property practitioner? On an annual basis, they need to give to them a copy of Annexure 8. On Annexure 8 is that trust account environment report. Now, aside from that, what else do they need to give to your client? The PPRA, the regulatory authorities, response letter, where they acknowledge that they've received the trust audit report from the auditor, the PwC of the PayProp of the payment processing agent. Okay, so payment processing agent needs to give these two letters to your client. Now, on the next slide, we're going to see how that affects you. So each mandating business property practitioner client, in other words, your client being the property practitioner, each of those, you will have one. What do they need to do? They need to make available those documents we've just gone through in the previous slide. So the environment report and the email response report from the regulatory authority, they need to make those two available. What else do they need to make available? The trust account exemption letter. In other words, the fact that they've applied to close their own trust account and open up one with a payment processing agent, they also need to make that letter available. And to whom? They need to make it available to you as the auditor or the independent reviewer of the business records. Okay, so this is how it all ties together. Your client has closed their own trust account. They've applied for the exemption. They've opened up an account with the payment processing agent. The payment processing agent's auditor is going to take care of that trust account audit. You don't get involved there. you're going to get involved in the business records engagement. Part of the business records engagement, you need to ask for certain letters. What are those letters? The letters from the previous slide. Annexure 8, which is the trust environment report, and the email response proof from the regulatory authority, as well as Annexure 10, which is the exemption letter proving that they have, or confirming that they've closed the trust account, their own one, that is. So that's what you're going to need to ask for and inspect. Okay. So these are the changes that we are seeing in terms of the trust accounts. So the remaining changes have to do with other legislation, other sets of legislation that could impact on a property practitioner. Let's quickly take a look. So the first one being FICA. What's changed in FICA? Just a reference to the annexure. So when we think about the Financial Intelligence Center Act, how does that affect us on a property practitioner audit, on an estate agency audit? In part B of the trust audit report, we have to go and give some answers in terms, so as auditor, we have to give some answers in terms of FICA. In other words, we have to go and document the FICA number, and we have to confirm, did they enter into any cash transactions over the limit? That's our responsibility to ensure that they're compliant with FICA. That's part B of the trust audit report. So all that's changed in terms of guideline 8.9, which deals with FICA and the impact on our property practitioner clients, is the reference to Annexure 2, which used to be Annexure 5 because the trust audit report reference has changed. So that's all that's changed. You still have those same responsibilities. This paragraph B still stands. Now for the Debt Collectors Act, how has this changed? So if we think about the Debt Collectors Act, the Debt Collectors Act is an act that runs in parallel to the Property Practitioners Act and regulations. It's quite a similar set of legislation, but it only applies to certain property practitioners. Which ones? Those that are deemed to be a property manager who collects rent in arrears or levies in arrears. They are debt collectors. So it's not all property practitioners, only those that collect arrear rent or levies. In other words, they are property managers. Those property practitioners also meet the definition of a debt collector, meaning the Debt Collectors Act, DCA, applies. And so the Debt Collectors Act has certain obligations. These are the requirements that you need to follow. If you're a property practitioner and you meet this definition, these are the requirements. Now, one specific requirement that was slightly amended was, on the one hand, you have to open up a bank account as part of the Debt Collectors Act, but you also have to open up a bank account under the Property Practitioners Act. Okay, so there's a double requirement. So in other words, the fact that you open up a trust account because the Property Practitioners Act requires it means you don't need to go and open up a trust account again because of the Debt Collectors Act. Okay, so your trust account will suffice in that case. Now, what's going to happen is that your bank account is going to accrue interest. What becomes of that interest? The Property Practitioners Act says it goes to the trust creditor if you've agreed to it. If not, it goes to the Fidelity Fund. Now, in terms of the Debt Collectors Act, it counters that. It says, actually, the interest that's going to accrue on this trust account that you opened or this bank account that you've opened, it needs to go to the Debt Collectors Council. However, the Property Practitioners Regulatory Authority and the Debt Collectors Council have an arrangement in place. And so they've said that we will not require that you need to pay over the interest to the council. You will just follow the act and pay it over to the Fidelity Fund if needs be. So in other words, the amendment was, they've just clarified to say that this requirement to pay interest over does not apply, or sorry, is not going to be enforced on property practitioners that are actually registered with the regulatory authority. Now for the last set of legislation being the Auditing Profession Act, Guideline 10.3, that's where we're seeing the specific amendment. Pretty much the amendment has to do with reference to an annexure that's changed. So it used to be Annexure 5, which was the Trust Audit Report. It's now Annexure 2, still the Trust Audit Report. Now remember, when it comes to the Auditing Profession Act, you still have a responsibility. Your responsibility is in Part B of the Trust Audit Report. It says that you have to just clarify if you've reported a reportable irregularity or not. So that's all you need to do here in Part B. Did you report an RI, yes or no? Okay, so the only amendment is just a reference to the Trust Audit Report being Annexure 2. It used to be Annexure 5. And it's in that annexure that you find Part B where you find your APA responsibility, which is to clarify if you've reported an RI or not. The second last thing to look at is the transitional provisions. What has changed? So the transitional provisions, how is that relevant to us? These are necessary because this helps us move from the old Estate Agency Affairs Act to the new Property Practitioners Act and regulations. And so the only thing that's changed is two particular guidelines, Guideline 12.2 and Guideline 12.3. And so what it sets out is that dependent on your client's year end, that will determine if you have a 4-month audit deadline or a 6-month audit deadline. So under the older State Agency Affairs Act, we had a 4-month audit deadline. Under the new Property Practitioners Act, it's 6 months. Now, which one applies to our 2022 year end? Okay, and it depends. So in other words, if your client has a 30 September 2021 year end or earlier, then you have a 4-month audit deadline. And so that audit deadline applies not only to the trust audit, but also to the business records audit. Okay, so the amendment just says, the amendment that was brought in was just to add reference to the fact that this 4-month deadline doesn't only apply to the trust audit, it also applies to the business records engagement. Okay, in the old guidelines, it didn't have any reference to the financial statements. It only had reference to the trust audit. So we weren't sure if this applies to both the audit and the trust engagement, or the business records audit and the trust audit engagement. On the other hand, if your client has a 31 October 2021 year end or later, then the 6-month audit deadline applies. And so the amendment just introduces some additional words. So the 6-month deadline doesn't only apply to the trust audit, but also to the business records, either if it's an audit or a review. It applies to either. And so the very last amendment is to look at the annexures. And so this particular annexure, Annexure 3, this was changed. How was this changed? Or Annexure 3, Annexure 3, how was this changed? So what Annexure 3 sets out is the summary of the audit requirements. In other words, if you want to know what audit engagement you need, or what type of engagement, be it an audit, be it a review, which one applies? So on the business side of things, and then on the trust side of things, this annexure sets out those requirements from the Act and the regulations in summary. And so what was specifically changed was that they just brought in some clarity because there was a conflict. So when it comes to the business records, we're only going to focus on the business records. When it comes to the business records, the default is that you have to have an audit. But under the right circumstances, you can escape an audit and therefore only need to undertake an independent review. So there were 2 ways. There are 2 ways to undertake an independent review. In other words, be exempt from an audit on the business records and just have an independent review. The first way is through the revenue test. So if we look at category 1 here, it says business property practitioners that have not been granted an exemption from holding a trust account. That is the second scenario. So the first scenario is the revenue test, the 2.5 million. The second scenario that leads to an exemption from an audit, meaning you only need an independent review, is if you've closed your trust account or you've been exempt from a trust account. Okay, so if you still have a trust account, which is this first category here, then you must apply the revenue test. If your revenue is above 2.5 million, then you have to undertake an audit. If your revenue is below 2.5 million, then it's a review on the business records. On the other hand, if you've closed your trust account, in other words, you're exempt from a trust account, then there is the possibility for you to either have a review. However, it can be overridden if you are a company or a CC because the Companies Act might override it. Okay. So again, the 2 scenarios to be exempt from a business records audit and instead have to undertake an independent review is the revenue test. Okay, so you'd only think about the revenue test if you still have a trust account, in other words, category 1. If you've closed your trust account, then you qualify for an independent review. But if you're a company or a CC, you mustn't stop there. You must go a bit further and test yourself against the Companies Act. Maybe something in the Companies Act could cause that independent review requirement is overridden. Okay, you close your trust account, you qualify for a review, but go and test the Companies Act because that might override that, meaning you need an audit. Okay, so all that was clarified here was that they just made these categories a little bit more understandable, a little bit more simple because there was a contradiction. Okay, so only 2 ways to be exempt: revenue below 2.5 million, or you exempt from a trust account, and the Companies Act doesn't push you out of an independent review into an audit. Right, ladies and gents, you are welcome to go. Thank you so much for your time. God bless you and keep you till we speak again. Thank you so much.